Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB this Wednesday. I'm Juliette Sarli, and we have seen a nice rebound on markets. Of course, we got that sell-off this time yesterday as those tariffs on China came into effect. And in fact, we are seeing a little bit more of a sell down into the close again today. But the fact that China's retaliatory response has been seen by many in the market as somewhat restrained did give a lift to the local market. And I actually wonder whether that chart might be just not quite showing the full picture, because I'm seeing the ASX 200 up by 0.5%, 43 points, 8417. It looks like the CBO 200 has had a much more muted session of only 0.33%. But let's get to some of the themes of the day in terms of course, China striking back with these tariffs coming through, 10% on some commodities, 15% on the likes of LNG. We had a great chat with Saul Kovanovich from MST Marquee earlier about the impact to Australia, and certainly, of course, in terms of some of the moves we've seen oil actually nudge a little bit lower. That's more on the fact that, of course, the trade war, if it does escalate, is going to be seen as very much hurting global growth. But when you look at the likes of some of the mining players, that was a big boost coming through to the space, particularly with iron ore topping $104,000. No word though on when US President Donald Trump and China President Xi might actually have a conversation. Also some M&A moves, and we saw that in the likes of Fortescue Metals. Let's have a quick look through some of the sectors of the day, kicking it off with those mining players today. Rio up 2%, Fortescue up 2%, taking over Red Hawk Mining, and on that pop in iron ore prices. Looking at the energy players as well, Woodside and Santos looking particularly good. And when it comes to the tech outlook, of course, you actually saw Alphabet, so the Google owner shares slump 9% in after-hours trade on Wall Street. A lot of analyst concerns there that the US tech giants are spending too much on AI, but are tech players looking quite good today? A quick look in terms of some of the corporate news. Another development in the Insignia saga. Insignia Financial receiving a new non-binding proposal, this time from Brookfield, to acquire all shares for $4.60 each, which matches the Bain and CC Capital offers from earlier in January. And Insignia was up 7% today. Amcor higher after announcing a dividend of 12.75 US cents per share. Pinnacle Investment shares hitting a record high after reporting net profit after tax of $75.7 million. And Fortescue, of course, increasing its offer for Red Hawk Mining. It will now acquire the company at $1.20 per share. It has approximately 78% of the company now. We are going to get to our guest, Mark Gardner from MPC Markets, in a short while. But first, because it is reporting season, we've heard from Bunnings Warehouse landlord BWP Trust, and it's increased its first half profit, with the REIT posting net profit of $157.1 million, up from $53.2 million a year earlier. To discuss, MD Mark Scatina joining me. Great numbers, Mark. What are the highlights in your words?
Hi, Juliette, and thanks for having me. Yes, look, we were pleased with the result for the half that we announced today. So some of that was the benefit of the NPR transaction that we completed in the last financial year. But we saw rent, like rent income growth up around 3.3%, which was a strong contributor. And if we think about pre-tax earnings before our revaluations, they were up 15%. So look, a nice set of results in terms of underlying metrics. Occupancy was up, WALE was extended, and as I said, like rental growth was pleasing at 3.3%. And in terms of tenant activity, we completed a number of market rent reviews with Bunnings, and also some expansion activity with a couple of key tenants. We committed to those. So as we focus on growth and optimisation, a couple of those things are flowing through the result.
Yeah, let's talk about that, because you are targeting further profit growth. So you've got this $14 million expansion, I understand, of the Bunnings warehouse at Pakenham in Victoria, and also an $11 million redevelopment of a car showroom. So tell us how all of that is helping your bottom line.
Yeah, so those will play out over the next couple of years, but it's really pleasing to support a key tenant like Bunnings, in expansion activity. That gives them more selling floor. They can improve the density of their trading, and we're pleased to fund that at a rate that's reflective of our cost of capital. So that expansion will come to life over the 2026 calendar year, late in that calendar year, and we'll fund that investment on behalf of our key tenant. And we're pleased to secure a new term for that lease of 10 years with a number of 6-year options thereafter. So that's a nice outcome and good collaboration with a fantastic tenant in Bunnings. And then Carco at Midland in Western Australia, they've got a growing proposition there and are very keen to expand their car showroom offering. And so again, we've reached agreement with them, slightly shorter time frame of build, but again, a 15-year lease with a 10-year option, and we're pleased to fund that again at a rate that's reflective of our cost of capital. So we are looking for opportunities to support tenants as they want to grow their enterprises, and we'd like to be able to partner with them and fund activity, which over time increases income, and therefore we can improve the distribution to unit holders.
Well, speaking of that, you have increased that interim distribution 2% year on year, 9.2 cents per unit. What is the outlook as you look towards the start of the second half that you'll be able to increase the full year dividend?
Yeah, so we reaffirmed our guidance for the second half, consistent with the first half and consistent with the guidance we provided 12 months ago, which was in regards to an uplift in distribution per unit to 2% for the full year, of 2%. So yes, we've guided again and confirmed that, and we're pleased to reinstate some growth in the distribution outlook for unit holders.
I was just going to ask you as well, Mark, in terms of the fact that we are expecting interest rate cuts, how does that potentially change when it comes to rental income and potential rent reviews you may have?
Yeah, so the major drivers clearly of the P&L are most certainly the funding costs. We guided for the half that our interest costs were up on the prior corresponding period, a reflection of obviously where the interest rate movements have been. To the extent that they would move in a different direction, then that will drive the cost structure of the trust. And then from an income perspective, we guide. We've got a number of leases that are CPI backed. We've got a number of leases that are fixed in terms of their escalation. They're typically about 50-50 in terms of the composition of our network, and so we would always guide to somewhere between the midpoint of the RBA cash rate. And then perhaps 3% from a fixed perspective, and our rental growth will reflect again that lease composition that we've got. So yes, there'll be drivers both in the numerator and in the denominator, we most certainly are always looking to optimise the cost of capital and make sure that we fund the entities as well as we possibly can.
Is any of that looking at, I guess, divesting some of your assets that aren't performing as well?
Yeah, it's not so much about not performing, but sometimes Bunnings will exit, and there may be a highest and best use that we'll try and activate. And we've done that in the past with an asset in Wollongong, where we went through a planning approval process and managed to realise a very nice outcome for unit holders. We've got an asset at the moment in Port Kennedy in Western Australia that we're looking to divest, and we absolutely think that relative to other options, whether that's another leasing campaign or a divestment or a development, we think that a divestment for that asset is in the best interest of unit holders. So we'll of course assess all of the assets on that basis. We do that frequently, and whichever of those scenarios plays out in terms of the most incremental for unit holders, we'll take that course of action. But Port Kennedy really is the asset that we're looking to divest at the moment.
When it comes to the overall macro picture, we talked about the likelihood of interest rate cuts, Mark. What are you seeing as broader implications, particularly if we do see a global trade war kicked off, and how that could potentially affect businesses like yours, even in terms of things like hiring plans?
Yeah, we've got a tremendous customer, a very large customer in Bunnings, and we're very privileged to have them as our key tenant, and they they are very durable, they're very adaptable, highly agile. So, whether it's a large economic cycle or something more domestic, or a change in perhaps customer proposition, whether that's a move to online, Bunnings navigates those cycles very well. And so, our response typically is that, the income of the trust, as I've said, underpinned by a really high quality tenant base, largely led by Bunnings. So from an income perspective, we're very confident. Then from a cost perspective, interest rates somewhat uncontrollable. Of course, we have some debt that will refinance over the next 6 months or so. So we'll be watching eagerly as to the timing of that, and where we source that replacement debt from. So yes, lots of factors, some controllable, some uncontrollable, but again, the portfolio is in good shape.
All right, in good shape. And as you say, the property revaluation uplift slightly offset by some of these higher funding and operating costs, financing and operating costs. Where you sit in the share market, I know as a CEO you'd always like to see more value for shareholders, but do you think that you're fairly valued, or how are you reading the overall market at the moment?
Yeah, I think there's been a bit of commentary even today. We typically don't get as much coverage as perhaps some other REITs, given the defensive nature, perhaps of our proposition. But look, we think we've got an incredibly strong covenant mix. We've got great lease structures. We're in great locations, and we have a history of funding and capitalising on opportunities well when those market opportunities arise. So, we've got an NTA that is sitting, in the high $3. That's underpinned by really robust valuation methodology that we assume, and of course the unit price is trading at a little bit of a discount to that. So. We obviously encourage investors to think through that and make sure they're of course understanding the mechanics of our enterprise, which we try and do through all the discussions we have with investors. But look, we think the outlook's positive. The portfolio quality is improving and has improved, and whether it's occupancy, WALE, or development, or market rent reviews, or option exercisings, those things. We're pleased with how they traded or how they tracked in the 6 months. So, and we hope that they continue in the next 6 months.
All right. Hopefully we can chat to you then as well, Mark. Thanks so much for making time for AusBiz. Mark Scatina, MD there from BWP Trust, joining us from WA. All right, back to the studio now, and another Mark Gardner from MPC Markets. Hello.
Good afternoon.
So, how much whiplash have you had since we last spoke a week ago?
Trade war seemingly turning out to be more of a pillow fight than anything else. Sort of wrote an article today about it. I mean, essentially it is the 4 pillars of the art of the deal, the book that Donald Trump wrote back in the day, essentially. Go out there and obviously set a high anchor point, involve multiple parties, and then embellish the truth and essentially engage the media and to try and get a deal done. So that, he wrote that 25 years ago, and
he's still using it.
He's still, it's almost exactly the playbook again. So I think China's response was expected. Obviously, the moment they knew Trump was going in, they knew something like this was going to happen. They're probably 3-4 months ahead of the game, to be brutally honest. You won't see any reactionary response from them, I wouldn't have thought. I think they'd be focused more on their domestic, their domestic situation and their stimulus, etc. But as my colleague Jonathan Chakadana had on the trade recently, China's has got such a stranglehold in so many industries. I really think the tariffs against China, Mexico and Canada are really just a lot of it is posturing. I mean, we saw it. Obviously being put in place,
then suspended.
It seems like a bit of a pantomime at the moment overall. And
well, let's not forget he's a reality TV star as well, so he knows how to work the media.
To hell with economics, or anything, or any trade agreements or whatever. So you've kind of got to take a broader view and not react to the noise, because there's going to be a lot of noise essentially. I was reading on my phone on the way to the studio, he stopped UPS delivering parcels from China. I mean, we could have which is borderline childish, to be brutally honest. So it'll be part of it will be pandering to his crowd, not necessarily policies. And what you want to focus on is what's going to actually go into policy. And if I had any advice for any trade ministers in Australia, we haven't been mentioned yet, just keep your mouth shut and just stay out of the firing line. The longer we remain unnamed in this whole debacle, the better it's going to be. We tend to think that we will possibly hit that sweet spot of neutrality where China and the US will need we'll need resources from us. So, and we'll hopefully avoid any sort of being affected in any sort of trade war. It might be actually beneficial for some of our miners. Overall.
All right. Well, let's drill down into some of the corporate news, because it's also reporting season. You just heard my interview there with BWP Trust. It's one stock that's done well today. What have your sort of takeaways been so far in terms of what we've heard? It's very early days.
Well, listening to Mark, obviously, all the right signs for a REIT. It's yielding well, increased yield, valuations are improving. They're increasing the whale. It's not one we've tended to look at because they've got cornerstone tenants, but obviously hearing him talk just then, the advantage of going and being able to develop with a cornerstone tenant and that lease tied to it already is obviously going to bring down their funding costs. So it sounds to me more, unlike a Goodman, which is high on development with about 14 billion in the pipeline. These guys are a touch more conservative. It's a lot more about balancing their funding costs because they know they've got those cornerstone tenants. So, it was sort of good to hear it from the horse's mouth. And obviously those valuations lifting slightly, we might see some improvement in some of the REITs overall. Goodman's come back off those frothy highs at the moment. We overall it sounds the quality businesses are doing well, and I think that'll probably be the theme again this earnings season. The quality businesses will do quite well, and you could see some sharp movements for businesses that aren't doing well because we've had that lingering interest rates lingering a little bit higher, and but overall retail sales, employment, inflation's coming back into the band, but subject to government subsidies, part of that last move. But I think we will see some outstanding results from some companies. And obviously the rest could be really harshly dealt with actually because we're really, I think the consumer's really running out of steam at this juncture.
We also heard from Pinnacle today. We spoke to them as well on AusBiz. Their shares hit a record today on their numbers, and still in the financial space there's this battle still for Insignia Financial. How are you watching that play out?
Well, as soon as there was a second bid, you sort of caught our attention, basically. I had it on the call and it was a throwaway comment, but I'd said if Bain Capital comes back, maybe this goes higher. And I probably should have listened to my own advice at that stage because we didn't really get on for.
Could have made 7% today.
Oh, just today, but I think it's been heading higher. But and Pinnacle as well. It's fund inflow is the key to success, and it's a pretty simple equation. Quite often some of these fund managers will actually underperform, but they've got really good sales guys. So so that's the thing you've really got to watch overall. And GQG, Regal, and Pinnacle. Well, Pinnacle probably a third, but GQG and Regal are the popular kids at the moment. They're getting all the fund inflow. GQG up until recently had the performance backing it up as well because they were heavily in the US tech sector. And getting outstanding results. So, just follow the money in those situations overall.
Well, I just want to pick up on that tech sector because XYZ, I see it up there, but it's still called Block. It's just the ticker code's XYZ. It was down 5% today. Alphabet falling quite sharply on this concern that maybe some of these behemoths are spending too much on AI. Yeah,
as we covered in the high conviction with AusBiz, we were looking at the next phase of AI, and I think some of these incumbent Mag 7 stocks, particularly, I think you'll start to see them run out of steam. And it's not because they're bad companies in particular, but we are looking towards that next phase of investment where it'll be more the software and the monetisation, the business productivity and efficiency gains that companies will get that will be where we'll see the outstanding gains. One of our high conviction recommendations is Palantir, which has had a very good run this week as well, was up 25%. So I think the market's starting to look for the growth in that area. and those companies that are either increasing their margin by increasing their productivity or efficiency through AI, or actually monetizing AI. So I think we'll start to see a shift over the course of the year, and we'll start to see those infrastructure plays. I mean, DeepSeek really only just triggered what most people were thinking anyway. No one keeps a monopoly with an 85% margin like that and a 5-year backlog forever. Technology always catches up. So we saw Alibaba come out with that as well. So, which will actually make for some pretty interesting investing, because if you'll be able to pick some fairly decent compounding winners and growth stocks in that US space. So. It certainly will be interesting times, and it will move incredibly fast. And add to that, Mr. Trump or President Trump distracting us every second day with a new wacky scheme or policy.
We've got to be more savvy, don't we? When he's like, "Look over here, what's actually happening over here?" Maybe
it is a bit of a magic trick.
Yes.
I've never seen someone who can put out a scandal or a fire by just lighting another fire somewhere else.
Yeah.
You've got to give the guy credit.
Yeah. The art of the
President.
deal, as you say.
Yeah.
All right, we'll see what next week brings markets. Never dull, is it, in markets?
No.
Mark Gardner there from MPC Markets. All right, our stock of the day today was Amcor. Koshy was joined by Henry Jennings from Marcus Today and Rudy Philippek van Dijk from FN Arena.
Amcor, I guess they did the company-changing merger effectively with Bemis some time ago. They've also done the Berry acquisition as well. So it's a company on the march, and it's obviously exposed to packaging, big time in the US. You'd have to think that it's a defensive stock.
Reaction
has been
sort
positive.
of the update.
Yeah, it has been positive, and I think the market likes what they see so far about the two acquisitions. One big, one not so big. But I think the market is getting more comfortable with it, because we have seen in the past, Australian companies can be tempted to go overseas, make these big company-changing acquisitions, and they fall very flat.
Yeah.
This one seems to be gaining some traction.
They've had a little bit of a tough time. The big acquisition of Berry is essentially to guarantee them more growth in the future. It was a long-standing ambition from Amcor, and Amcor has been very acquisitive in the past. It's one, if you take a view from a little bit from a distance, this is one of the multinationals we have on the stock exchange.
Yeah.
Has been post GFC very, very profitable and successful for a very long time, but in recent times lost the momentum a little bit.
All right, let's have a look at the leaders on an update on the market. Kicking it off with Clarity Pharmaceuticals having a good day, up almost 10%. Insignia, we had mentioned there on the fact that it had a new offer now from Brookfield. So 3 bidders looking for Insignia. BWP Trust, I just spoke to the CEO, Mark Scatina. They did very well on an increase in first half profit. Neuron Pharmaceuticals and Westgold also performing well. To the downside today, Block, we mentioned that as we saw some weakness coming through, or huge weakness coming through in Alphabet after the bell. Macquarie Group, Zip, Guzman y Gomez, Aurora also weaker today. In the small end of town, SBC Global rebounding up 21%. Bluebet, it had an agreement out today as well, an update to the market. Shares up 21% to the downside in the small end of town. Looking at Atlantic Lithium amongst the losers, and BetMakers Tech, which I believe also came through with a market update. Shares down 6.4% to 11 cents. Having a look at what we are looking out for in the US session tonight, we've got the US ADP employment change for January, the ADP jobs report. Also services PMI data coming through from both S&P Global and the ISM. Worth noting as well, Walt Disney, Arm, Ford, Novo Nordisk, Qualcomm and Uber all coming through with earnings. Tomorrow we have the international goods trade for December coming through, and also earnings coming through from the likes of Beach, REA Group and News Corp. Now, REA Group was a really interesting one. I spoke to Jessamine last week. She thinks that stock is going to pop on the earnings. You can find that interview on our website, ausbiz.com.au. We spoke last Friday, I believe, and the title, if you're searching for it, is Jess Thinks This Stock is going to Pop. So an interesting one to look at ahead of its earnings tomorrow. Let's have a look at where the market finished up. Just 0.1% there on the CBO 200, but a much more solid session coming through on the ASX 200, up 0.5%, 43 points, 8,416 points, as the market very much viewed the response from China to the US tariffs as restrained, or as Mark Gardner said, it's more like a pillow fight so far, this so-called trade war. That does it for today. We'll be back from 9:45 a.m. Eastern tomorrow. See you then.